Well, hello, everybody. Welcome to our QSEC webinar for today. And we're talking to Sefa today, which is very exciting, around demystifying debt. Everybody complains to us a lot around not being able to access finance. So it's really fantastic to have Sefa in the room to be able to talk us through some of these points today. We always like to start our sessions with an acknowledgement of traditional owners. And we're coming to you from Yagara and Turrbal country today. And it's not just about recognising the place and space that we're occupying today, but it's also about recognising the incredible wisdom that Indigenous and First Nations people have brought to this sector for a very long time. So we would like to pay respects, obviously, to ancestors past and present from this country, and also respect to people from First Nations who might be watching this, for their contribution to the emerging landscape of strength that we are noticing in Australia, across Australia, for First Nations voices. So thank you once again for joining us here today. I am going to stop sharing my screen and I'm going to introduce you to the team at Sefa, which is Tanya and Manfred. So I'm going to stop my screen for a moment there. And Manfred, do you have the slides that you want to show through on your screen now? Or Tanya?
I can do that.
Awesome.
Let's see.
So welcome both of you. It's really fantastic to have you both here. You know, what we noticed is that a couple of years ago, we had a huge adventure into social finance because there was a really large push from Queensland a couple of years back now, really wanting to understand what the levels of finance were available to social enterprises. We know that this is a bit of a pain point for social enterprises, particularly in the learning and learning stage and the growing stage first up, but also as businesses expand and grow and scale, finding access to different kinds of capital along the way can be really complex and really tricky. So we did a 6-part series, and Sefa was part of that. And Hannah Ebling, your CEO from Sefa, actually did an amazing session. So QSEC members on this call and listening to this recording, go back into the learning portal because you'll find an incredible, very deep hour-long conversation with Hannah Ebling around some of the things that Sefa have to offer, but a really great understanding of what debt can actually do to help your business grow and scale. But I'm going to hand it over to Manfred and to Tanya now from Sefa to take us on this fantastic journey around demystifying debt. Welcome, guys.
Thank you so much, Elise. It's such a privilege to be able to join all of you today, and I guess help to clarify a topic which might be potentially appear to be quite complicated and intimidating to some of our fellow QSEC members. So I also just want to acknowledge traditional custodians of the lands from which we're all joining. I'm personally coming from the land of the Camaragal people today, and I particularly in these sorts of circles like to recognise that the Indigenous people of this country were the first social entrepreneurs on this land. So in terms of giving you a bit of an outline of how we see the session unfolding, so I think we were looking at sort of overall about 50 minutes. We'll leave some time for Elise to wrap up at the end. But essentially today was all about debt funding for social enterprises. And so at Sefa, we really want to help organisations like yours to guide you through a journey which can sometimes feel like we're moving through thick bush without a walking track. And so our aim is to make it easier and quicker for you to do that if debt is an effective option for you and your organisation. And we do kind of want to point out up front that it's not necessarily an effective option for everyone, but the whole point is that you know, you can only make it a good decision if you have the information. So we're here to help you make an informed decision either way. There's a lot of points on the slide, but essentially we wanted to split the time into roughly 2 parts. The first part is everything before the AMA, the Ask Me Anything section. We'll sort of For those who may not be as familiar with Sefa, we just wanted to let you know a little bit about us and also clarify what debt is, how we think about loans, some examples that we've, example clients that we've worked with. And then, because you're all very kind to nominate your top questions, burning questions that you wanted to be covered today in your registration, we want to address some of those. And then the Ask Me Anything section will be the latter 25 minutes, which Manfred will kindly lead us through. And so, as you think of any questions during today, or if you already had some that maybe you've thought of since you filled in the registration form, definitely use the Q&A function in Zoom. Or alternatively, you can make a note of it, and then we'll come to you if you raise your hand. I'm sure our QSEC friends will organise so that you can pipe up if you would like to tell us your question at the end. All right, just quickly some personal intros so that you know who you're hearing from today. As Elise mentioned, so my name is Tanya Wong. My pronouns are she and her, and I'm a senior relationship manager in the social finance team at Sefa. So what that means is that I'm helping organisations like yours to navigate that debt funding process from beginning to end. I've been with Sefa for over 3 years now, and before that, I spent many years at Macquarie Bank in the specialist lending business, which I will say was pretty good training actually for Sefa's lending approach, which is very bespoke to each of its clients. I did also do some further studies in social impact, so hopefully you don't hold the Macquarie Bank time of my career against me in this context. And so as Elise mentioned, we also have with us Manfred Bauer, who is Sefa's head of portfolio management. He has been with Sefa for 1.5 years now and brings extensive experience in developing internal capacity in hybrid organizations, nurturing regional networks, and fostering cross-sector partnerships throughout the Americas and now also in Australia. Moving right along. So just briefly for those who might be new to hearing about Sefa, we have been around since 2011. And in those 12 years, we've provided almost 70 loan facilities to all kinds of purpose-driven organizations around the country. So that's over $40 million, which then collectively has unlocked over $80 million of other forms of capital. That just means alongside Sefa loans, there were other funders as well for the various organizations and projects that we've supported. So that could be in the form of other loans, it could be equity capital, it could be government grants or philanthropic funding. At Sefa, our investment process is very sector agnostic. So we fund initiatives in all kinds of impact areas, as you can see on the slide. And we are specialists in debt. So that's the only kind of funding we provide. And so we're really pleased to be able to help demystify debt for you today. And just in case people feel like there's a lot on the slides, we will be sending, or through our QSEC team, I'm sending you a copy of the slides afterwards, so don't stress too much about writing things down. Okie dokes. And then for those who maybe hadn't really thought about debt or didn't really see how it might be relevant to the organizations, we just wanted to quickly touch on how, what debt is and what things it has similar to or different to sort of major other forms of funding. So on this slide, we're showing how it compares to grants and equity, being sort of in general terms, the two main other types of funding that organizations are typically receiving to help them grow. So the first feature we would say that differentiates debt from those other two kinds of capital would be that debt is repayable, and repayable in the sense that there is a plan up front, so before the money is even provided to the recipient organization, for the time and the amount of repayments. So obviously grants, there's no sort of expectation of financial repayment. That's the difference there. And then with equity, the repayment is very much conditional on the financial performance of the funding recipient. So Not to say that debt isn't responsive to the financial capacity of the borrower. I guess it's more that the equity financial returns sort of are very directly linked to sort of the ultimate financial performance of the organization. And then because debt is sort of typically tailored to the borrower in terms of the borrower's ability to repay in its financial circumstances. So even for organizations that maybe are not like Sefa and have a bit more of a uniform approach to the lending, you'll find that there are certain terms that will always vary depending on the recipient. So we're talking about things like how long the loan lasts for, how much the repayments will be, and how often, or the timing of those repayments, and then also the cost of the loan, which would be the interest rate. And I guess that differs mostly from grants and equity, where typically, you know, it's in a program for a grant, or for equity, you'll be raised in a particular round of fundraising. And that the nature of those forms of funding typically means that there's a much more consistency for the funding that's raised around the same time. And it's just sort of more consistent there. And then lastly on this slide, we sort of wanted to explore also the nature of the partnership between the funding provider and the funding recipient. So with debt, I think that initial process of the lender really getting to know the borrower means that there can be scope for much more active collaboration, in the sense that if circumstances evolve, the lender can be open to amending the terms of the repayment in order to sort of accommodate some of these unexpected things that might have come up. However, the lender is not an owner of the business, and so that actually would be still a lesser form of involvement than often equity investors might have. So particularly for smaller organizations in the early days, often they will benefit particularly from equity investors that bring expertise for that industry, or have particular contacts or referrals they can make to assist that organization to grow. And so as a co-owner of the business, that can set it up for a much more actively involved partnership. Whereas then I guess at the other end of the spectrum, grants can, some of them can be quite specific about the use of the funds. So I guess by contrast, debt can be more open-ended. Typically, there's some expectation of what the money is used for, but it may not be as strict in terms of the conditions. However, I guess the grant provider typically would be quite happy to sort of just get some sort of form of reporting, either at the end of the usage of the funds, or maybe only annually or periodically during the time the funds are being used. So we would portray, I guess, grant providers as being the least actively involved, and that of course they are also a partner rather than a co-owner. So compared to grants, we would say debt is sort of in the middle, somewhere between grants and equity. So that's kind of some of the features that we see as being relevant to distinguishing debt from other forms of capital. And so, as I had alluded to, as part of your registration for today's webinar, we asked you to nominate some of the more important questions that you would like to be covered during the session. And one of those questions that got quite a lot of interest was, can you show me some examples of social enterprises that have gotten a loan? So we've just got a few logos on this page to sort of illustrate some of the clients that we have worked with in the past. But we also are happy to walk you through a couple of specific clients and their experience as a Sefa borrower, to illustrate how the loans not only sort of help their business from a financial perspective, but also help them produce great impact outcomes. So the first one we wanted to talk to you about was Carden Construction. So they're an Indigenous business based in Perth over in WA, and they provide diverse employment opportunities for marginalised cohorts, and in particular Indigenous young people. So they came to Sefa in late 2020, and we were able to help them with a couple of loans with a total of $1 million altogether. And this was split into, firstly, a line of credit. So what was happening at that point, the Indigenous procurement program over there in WA had been sort of launched a few years before that, and Carden, you know, they're very sort of high quality construction company, but as in along with this trend towards increasing contracts being awarded to Indigenous businesses, were really experiencing a great surge in demand for their services. So they were saying to us, oh, you know, we would really love if you could help us with some of our cash flow management, because what happens with as a construction company, when they win a contract, they are often required to fund a lot of the initial supplies, you know, timber, cement, whatever, so for, you know, a number of months before they actually achieve, say, the first milestone under the contract arrangement, and then they receive the first sort of installment of payment from the organization that hired them to do the project. So they said, yeah, can we look at some forms of finance for that sort of timing purposes, cash management purposes. So we were able to provide them with a line of credit, and that was initially for a term of 2 years, definitely with the option to extend for another 2 years. And then they also said, okay, so as we're growing as an organization, we've currently got, you know, a small office, a small warehouse. We would love to actually use some of that warehouse space to expand our office, because they were next to each other, but then actually we need a bigger warehouse in another location. So that one we provided them a term loan for, and that was a 5-year term duration on that one. But what happened was actually they, you know, continued to do very well with their business. They were able to increase their turnover by 2/3 and double the number of apprentices they had on their team, which was wonderful. And then they ended up being able to refinance our loan. So I guess, you know, as part of their business, it was working very well for them to have these loan facilities in their capital structure. But what happened was they were able to get some much more favorable terms from a mainstream, or say Big Four bank. So the interest rate was much lower, and the loan term was much longer than what we had initially agreed with them. So in this instance, you know, as at Sefa, sort of part of our theory of change and our aspirations for the sector is to be able to see more and more enterprises to be able to tap into more mainstream forms of finance, because that's sort of better for them in all sorts of different ways. So we felt like, you know, our job was actually done, and this was less than 2 years. So that first line of credit didn't even get to the end of the initial term that we discussed. So from our perspective, that was a real success story to be able to assist Carden at that time of rapid growth. Now, the next client example we've got, I'm going to hand over to Manfred to talk about that one.
Great, excellent. Thank you, Tanya. Hi, everyone. So the one that we have here is 42 Adelaide. So this is part of a network of free coding schools based in Adelaide. They began operations around 2.5 years ago. And what this school does is it basically attracts a diverse group of disadvantaged people, especially young people over 16 years old. And the idea of the school is to upskill them and connect them through this coding curriculum to companies to meet the demand of IT roles. But overall, a group of students can actually tap into other industries as the curriculum has evolved over time. We engaged with them very, very early on as they were trying to set up the organization and begin operations. So what we were able to provide to them was a 3-year facility worth of $490,000, which half of it was guaranteed over the by the government guarantee under the SME scheme. The use of funds that we were able to display with them was to set up the organization and begin operations. So definitely they were looking at buying equipment, leasing a warehouse or a office space where they can host all those students who were coming in on a day-to-day basis to have access to the free coding and some teachers and supporters throughout that process. What was interesting for us is that supporting this organization early on, it just realized the ability for debt to play a role in a catalytic way. So we're able to look at how, first of all, supporting an early stage business showcase positive outcomes, such as the repayment was always has been on time, with the ability of making additional repayments based on their performance. They have shown profitable and growing numbers, more than 60% year to year. They've been able to also grow and increase their pool of students that they support on a year-to-year basis. They've been able to also, showcase, as of May 2023, quite substantial level of profit, which means that the organization is not just sustainable, but it's actually growing at a healthy rate. So yeah, we're still in conversations with them as they grow, because we have this term loan of 3 years. But it's just another example of how the growth capital and debt can play a role in supporting these organizations as they grow. Over to you, Tanya.
Thanks, Manfred. I noticed that Elise asked a question, which I think I'm happy to sort of address it now, as opposed to leaving it, because then we're going to sort of touch on some other questions. So Elise's question was, noticing that the social enterprises you've selected paid ahead or on time. Is this common in the sector, or have you cherry-picked them for us? So it's very interesting, Elise, that you asked that and you picked up on that. I guess we did want to make that include that, I guess, in people's concept of how things pan out after the money is provided. But we have recently looked actually at our data, and also I probably shouldn't. I don't have the numbers off the top of my head, but there was definitely a significant minority in our clients that did make early payments. So whether that's they were kind of front ending the process, or that they were able to completely finish repaying the loan early. So some of them, it was just more about the timing, when they were in a good phase where they felt they could reduce the outstanding balance, they were able to sort of top it up a little bit. So we definitely welcome that as part of the partnership and collaborative arrangement. I suppose I was going to say for the others, which I think is the case with Adelaide, 42 Adelaide, which I don't know if Manfred wants to add anything. For them, they're saying that although they might be able to repay faster, it actually benefits them overall to sort of maintain that relationship with Sefa as a potential funder in the event that they're looking at other forms of expansion. And so therefore, it's a bit more of a fluid relationship, and they see debt as part of the way that they're going to continue funding the operations. So I would say that I think it's more that we would accommodate borrowers wherever they are. So it's very important to us to be responsible in the lending. And for those for whom it works out, yes, there are a not insignificant number of borrowers who find that, maybe some of the conservative nature of the assumptions at the start just gave them actually the room, and they're able now to sort of repay faster than maybe was initially planned, which is absolutely fine. A lot of it's a legal obligation, so we don't want them to feel like they're tying themselves to something that's very strict or very aggressive, but they can definitely repay faster as well in some circumstances.
And maybe if I can quickly add to your question, at least most of the time is also tied to the business model itself. So some businesses are actually growing faster because of the way they are structured and how they are entering a new market, or they're being able to grow based on their customer base. Some other businesses, we experience that the growth is steady, but is not hyper growth. So it just depends on how we structure the deal as well, to tailor and cater to their specific needs. So in the case of 42 Adelaide, we believe that they were in a growth trajectory early on, and that's just the early repayment, or the payments early, just showcases their ability to continue hitting important milestones financially. Yeah.
Yeah, and because we have our resident expert on the line from the Sefa team, yes, thank you, Max. The stat is actually 40% of our clients have been able to make early repayments. So that, again, that doesn't mean they were all fully paying off. I guess that's a reference to, yes, as and when they feel able to, they were able to sort of get ahead of the schedule that maybe was originally agreed. So yeah, it's we're not just giving you a particular slice of the picture. All right, so other than the show us some examples question, we learned that the top 3 most important questions for people who were attending the seminar, the webinar, was when is debt a good option for us? How much does a loan cost? And we're a non-profit, can we get a loan? So thank you for giving us that insight into the things that you want to hear about. So we just tackle them one at a time. When is debt a good option for us? We would say that it sort of really depends on the thing that you are trying to pay for. Like, what's the thing that you're funding by using the debt? Because if it can quickly increase your incomes, however it does that, depending on your operating model, then that will allow your organization to be in a better position to repay the loan within the time frame that makes sense for the lender. So that would be sort of, in general terms, the most suitable circumstances. So I know we also asked for those who were currently thinking about getting a loan or getting funding, what the reasons for that were. So some of the things we heard from you were working capital. So to maybe things like buying inventory or supporting your ongoing operating expenses, to hire new people or as new staffers or contractors. And maybe in one case it was to buy something which wasn't necessarily property or land, so presumably maybe something like a vehicle or equipment. And so all of those things it depends on your model. If you're able to clearly demonstrate that those things, when you pay for them, like bringing on new staff or, you know, getting a new vehicle, getting a new truck, that is going to directly translate into stronger revenues for your organization. Great, that sounds like a really nice way to a really good situation in which debt might be useful. Is not always the case. Just in case it maybe sounds a bit like a statement of the obvious, sometimes things might take longer, like even though you've invested the money, for that to translate into revenue. So that would be one situation. Elise, were you asking a question on that particular point?
Yeah, on that particular point, something that we've noticed most commonly with social enterprises is in the procurement opportunities that come up. So I guess I wanted to ask a little bit of a question in regards to that. So when people are going for tenders, and some of them are quite large, you know, they have a look at their pipeline for funding and, you know, where they can apply for debt, etc., if they should get this contract. Is there a case where Sefa would have a look at funding and finance options prior to a tender actually being landed, just to have a look to see what the conditions would be, and is that a conversation you'd be happy to have early on?
Really great question. Thank you, Elise. I would say that not trying to dodge your question, I think it really does depend on the nature of that procurement contract, sort of how much the time frame involved, you know, what's the certainty there? Because I guess the Carden example I did about, yes, we were very much keen to have the borrower demonstrate to us that they had been awarded the contract before we were providing the funds. Although I suppose because it was an ongoing facility, there was some flexibility in the sense that also for them with building, like it takes a few months to complete the contract. So I guess from their cash perspective, they were sort of able to manage that at a more micro level. I don't know, Manfred, do you have any thoughts on financing ahead of procurement contract?
Yeah, the only thing that I can think of at the moment might be just looking at the current status of the organization and looking at their financial position. If there's any ability to repay to a certain extent part of the and just meet the requirement of the repayment schedule, we might be able to structure a deal in a way that gives, you know, the organization a little bit of leeway and time to secure those contracts. But the certainty it's a word, and it's an issue that Tanya mentioned earlier, that is highly important, because remember that the only way we can find ways for organizations to repay a loan is based on their performance and revenue. So if we're looking at forecasting and future revenue and that's not secure, then we are going to enter into not being a responsible lender, right? We're probably over leveraging that organization and using capital in ways that they can probably, grow, but not being able to then repay in accordance. So timing, it's actually an important factor to consider in those scenarios as well.
I think my question was more about preparedness. I think, when a lot of our social enterprises are going for grants, sometimes, they need to be prepared. If they do land the contract, what conversations can be had prior? Obviously, there's no assurance that they're going to be able to get the loan until they can make the repayments. But is there any value in actually building that relationship with Sefa in the early days? Saying that, we've got X, Y, and Z contracts that we've got in the irons in the fire. What does it look like? Should we get X, Y, and Z? We need to scale at pace. Often the contracts will come through and they have a time frame to be able to deliver in. I'm wondering about the value of the relationship, probably more so than the security of a loan or of debt.
Absolutely. So the answer is resounding yes, because I think even in the case of Carden, like, they knew that they were seeing this ongoing uptick in demand, and so it was having that facility in place that allowed them to be able to go out and bid for a lot more of these contracts, because they knew as soon as they got awarded it, they would have this ability to draw on the facility. So for sure, yep. And not that it necessarily takes too long, but I mean, it's always great for Sefa, like the lender, to have had the chance to learn a little bit more about the business. And yeah, definitely it can be, all the sort of paperwork can be more or less settled, so that, as you say, as soon as the contract is awarded, then we can just sort of get the money out the door. I guess the last point to mention on the when is debt a good option for us question is that for those who are in a private company legal structure, so a PTY limited, the ability to raise equity is sort of, I guess, associated with a dilution in your ownership. So if you're the founders of the business, you would typically have most, if not all, of the original equity. So it's just bearing in mind that if it's quite important to you to maintain a large ownership stake in the company, then debt allows you a way to raise additional capital without diluting your ownership. All right, then on to how much does a loan cost? So I guess I think about this as in two ways. There's like a monetary part and a non-monetary part. So before we get into the monetary part, which I think is where most people start, the non-monetary part, what I'm referring to is, as I've alluded to, that sort of early investment of time and effort to really showcase your business or enterprise to the lender, so that they can understand what you're great at and why you've got a strong brand or strong reputation in your sector with your clients. So that can take a bit of time and effort. Probably, you've discussed this internally within the leadership team to understand why you're interested in the loan in the first place. But then to be able to adequately convey that to an outside organization like a lender, that also, you need to budget that into. So that's the preparedness, actually. I think Elise was talking about. You want to have that on your radar as you lead up to the time when you definitely need the money in your hands. So then if we talk about the interest rate, which is typically how a loan cost is about, the actual cost or interest rate against a loan will depend on the organization, the borrower, the purpose of the loan, and the lender as well. So sort of the larger organizations that do a lot of loans, typically they're able to source their capital at a cheaper rate than smaller one as well. So yes, their pricing would tend to be a little bit lower. So for Sefa, just to sort of get into maybe a little bit more specifics, for us, we would The range that we're looking at is sort of high single digits, 5 to 10% through to high teens, 50 to 20. And that really sort of, depends on, as we say, the circumstances of the organization and what you want the money to be used for. Now, sometimes when we have these conversations, or organizations do ask us, oh, well, okay, that seems quite expensive, Sefa. Like, why would I want to consider working with you compared to maybe some more mainstream banks or other finance providers that are out there? And that's a very fair call. And I think if the interest rate is the most important factor for you as a borrower to consider in your decision making, then that's a very understandable decision. If you've got these offers from other lenders, and I already talked about that. Sometimes that's where we see our clients graduating, I suppose, from the Sefa cohort, because they're able to access cheaper finance. However, we would say for organizations who we have been speaking to, and we feel that we're able to provide you with a form of facility that is customized to where you're at, we would say that we approach it as very much a two-way partnership. And it's a journey, and the benefits to the borrower, we would say, is much more than just getting the money in your bank account. It does increase, we find, and this is the feedback from our clients, increase your understanding of your value proposition as you operate, your operating model, your impact strategy, and the risks of the business, and more importantly, how you manage them, which then in turn leads to greater confidence in managing your enterprise and talking about it to various stakeholders, whether they're customers or funders or supporters or just other peers in your space. So we've definitely, seen that there's that sort of increased depth of understanding and skill in business management. And then also, I guess there's an increased credibility with all kinds of funders and supporters. So once you've got the loan in the first instance from Sefa, and also if you are able to demonstrate your ability to achieve those original projections and then make the repayments on the loan, even if it's just the scheduled ones, or as we referred to, making earlier repayments, all of that basically increases your standing from a financial perspective to any sort of other third party that you may be talking to. So that's what we would say that we offer at Sefa, which may not be obvious just from the interest rates that we talk about. And then lastly, on this slide, the non-profit organizations out there, can you get a loan? Absolutely. There's nothing in the legal structure of a non-profit that would prevent you from taking on a loan. So really the conversation there comes back to this old, I feel like I'm a stuck record, but it comes back to, why are you seeking the money? What are you going to use it for? How is that going to help your organization financially in order to be able to support the repayments that are involved in taking on a loan? All right, so hopefully that addressed some of the sort of more top of mind kind of topics. We are now very excitingly at the Ask Me Anything section as advertised. So I will actually hand over to Manfred shortly. I guess I will just remind again anyone, if you've got questions, happy to take them in the chat, or if you're happy to also, I think actually maybe our QSEC friends are going to facilitate the tech side. So if you raise your hand, I'm sure they will allow you to sing out with your question if you like that.
All right, thank you, Tanya. So yeah, we have about 20 minutes or so, or a bit less, to go through any questions you might have. We have a list of potential questions that we would answer in case there's not that many questions up front, but I'll leave probably a minute for Pushpa, Diane, or even Elise, Louise, if they want to throw any questions at us.
Tanya, I know there were some questions sent through earlier. There were a few people who sent their apologies who weren't able to join this section. So yeah, once the others have had an opportunity to ask their questions, if you wanted to go to your backup questions, that would be great, because we'll still have them in the recording then for any of those people who weren't able to join us live.
That's good. Yeah, I think Pushpa has her hand on, so hand up.
Pushpa,
So
did you want to take your question?
Yes. So a new charity about 4 years old, and I know you spoke about interest rates, still establishing. What would the criteria or circumstances be there? So say, for example, they're looking to get a loan to support a wage that's going to help the charity grow.
right. Yeah, that's an interesting one. So basically you're saying the organization has been operating for about 4 years. Is that correct? So I guess the main criteria at this point would be to look at obviously your level of track record. So it would be interesting to look at your current performance, look at the steps and the activities that you've gone through in order to get you where you are today. So that gives us an understanding of your ability to manage the business, stabilize it, and grow it. The other point that we would look at is obviously the potential of continuous growth, but also the certainty of being able to continue delivering on the same level of performance as you are today compared to forecasting. So the idea would be to look at some of your contracts, type of grants and type of revenue that you are currently securing, or that you've been able to secure, whether it is a 1 year or is a multi-year type of contracts. That gives us also an ability to test out and understand the level of commitment that you have with other providers, capital providers, to see how your business is going to be sustained over time. The other important criteria and consideration is the use of funds. So it might be interesting to look at where your energy has been focused on around allocating your resources to grow, and then what's your funding strategy and your growth strategy moving forward. So looking and contrasting that with the uses of funds, understanding where would you're hoping to allocate resources in the next 6 to 12 months to then make that correlation with your growth. So those are probably the first 3 criteria elements that we would consider based on your on where you are today. But I'll leave Tanya a bit of space if she wants to jump in and add any other points.
Well, you also mentioned the fundraising. So how does the organization support that?
Tanya, do you want to take that one?
Sorry, was that in relation to other sources of funding, Pushpa?
Yeah. So in general, how does the organization support fundraising?
Organization here being Sefa?
Your Sefa?
Because I suppose that is definitely something that Sefa can help with. Is that's more, I guess, a complementary other part of our business. So we talk about offering capital and capability building as part of our sort of service offering to the purpose-driven sector, and that doesn't just mean loan. So that our engagements team will again work with each organization on a case-by-case basis to understand what's the most appropriate and feasible forms of funding that would work for each client. I think you mentioned this, like your organization is a charity, so it sounds like we are talking more about grants and maybe debt and less about equity, in which case then it is much more about understanding your impact focus areas and your theory of change and outcomes, because that really is how typically, I guess grant providers, particularly if we're talking about going outside an existing grant program, like if you're looking for more bespoke kinds of grants, to suit the particular phase of development that your organization is in, then it's very much about aligning the areas of impact that you are focused on with the areas of impact that the grant providers are keen to support. So they will often be very clear about where they want to deploy their grants, essentially, and it's a matching game, right? You're going to find the foundations that are keen to help the same types of cohorts or causes that you are.
So is it, would we be able to just have a meeting or something just to discuss further what the options are?
Absolutely. Sounds like, yeah, there's a lot more details or specifics that we can get into, which we'll just take them offline.
Just to get a better understanding.
Yeah, and maybe just to quickly add on that and connecting that to the question about, why it's normally the loan might look a bit more expensive. This is an example of, the kind of partnership and elements that we bring to the table, and probably other lenders in the social impact space, where we try to cater the solution based on your trajectory, but also understanding your funding strategy. So the conversation and the engagement allows us to understand where can we actually play a role in your trajectory, rather than just focus on the mere transaction of, getting a certain amount of capital for your next step. So those elements are the ones that we capture through an engagement, and we are able to understand the better, how can actually debt can play a better role for you. And if not, then we definitely tap into the network that we have available to, as Tanya mentioned, knowing your intention and the core mission of your organization, who is the best organization positioned to take the conversation further.
That'd be great. Thank you.
We've got a question in the chat room around fees to set up the loan and early repayment penalties. How patient and how flexible are the loans, and how expensive are they to set up?
Tanya, do you want to take that one?
I mean, we can talk to the Sefa approach. So in terms of early repayment penalties, typically not. So that is something that we find, as I feel like I've alluded to a few times already, it's sort of a win-win in our eyes if organizations are able to pay ahead of the originally agreed schedules. So definitely no penalties there. The fees to set up a loan, we would, I guess it kind of depends on the loan. But if we get to sort of give you a sense, it might be like starting in the $3,000 level. So we would say that that's typically cheaper than a comparably sized loan from a sort of maybe larger or more commercial lender. But I guess for them, they're typically dealing with larger loan amounts. Actually, I didn't mention before, so our loan sizing would typically fall in the $200,000 to $2 million range. And if you're an organization that's doing really well, that $2 million is just referring to how much Sefa would directly contribute. So all those other sort of parallel forms of funding that I mentioned at the start of the session, that means that we're also very happy to be that coordinator. If basically if more than $2 million is needed, we can also have other friends and partners to bring along if required. So yeah, hopefully that helps answer that question.
Yeah, that's fantastic. Thank you. I'm going to do something really cheeky now. So we're seeing more and more interest from overseas, particularly from investors, about delivery of impact. We haven't really seen that a lot in Australia. It has, there has been some movement there, but it's not really huge like we're seeing, particularly from the Asian markets, and investors are really interested in the impact you're delivering. However, I'm going to say something really cheeky. It's not typically translating to a lower expectation of returns from those investors. So it's like they're saying, we want this impact, we want it to be delivered, but we still want our 12 to 15 to 20% returns, which is really kind of sad. And while I guess I'm going to put it out there. I'm dreaming of a utopia where investors and finance organisations and funding bodies start to really acknowledge and support physically, tangibly, the incredible impact that has been created by social enterprises and other impact orgs. And I'm wondering, Sefa, in your crystal ball, could you also see a time where the likes of a Sefa or a funding body and investors could potentially lower the expectation of those interest rates and figures? Does that unicorn exist? Is there ever going to be a trade-off for the impact, or are we going to keep delivering loads of impact and still pay for the impact and the returns? Oh, cheeky mic drop.
All right, I'll jump in quickly and try to answer from my point of view. But yeah, Tanya, happy to join the conversation. Yeah, it's a broad and complex question, but I would say, look, there's probably in every single investment an assessment of risk, return, impact, and the ability for the organization to deliver on the outcomes and being able to also perform financially. We know that social enterprises, are actually, quite brave and struggle, many times to balance the sustainability of the business while also deepening their impact. So we as Sefa, we definitely take a step back and try to evaluate, holistically the ability of that organization to keep growing. And then the question comes back to us as to how can we use that capital in ways that supports the organization without falling into not being a responsible lender, but also ensuring that the company, the organization is not in a trajectory for a mission drift as well. So it's just a fine balance. But we think that through the catalytic capital or these other labeling elements of capital in this space, we can definitely unleash impact in different ways. So the way we see it sometimes as well is how many organizations have the ability to actually access capital in the first place. And then obviously, how can we tailor that solution in ways that ensures and doesn't hinder the potential growth of that organization moving forward. The other element that I would throw in that I think is important to consider, and we've seen it as a team, is how the organizations are prepared to showcase their impact. So how good are they articulating their impact, their theory of change, their ability to measure and track their outputs, and ultimately their outcomes. And we know that that requires a bit of time to be able to do that, and also requires capital, and it's expensive, right? So what we do is probably we take a different approach, and we sort of think about it in, more as a patient capital, in a way that we structure a deal in a way that allows for the organization to find their feet, being able to sustain themselves, being able to grow, but at the same time to provide really deep impact. The other thing that I would mention as well is that we look at it from a lens of probably impact first. So the way we look at it is how the capital will contribute to this organization in the long run, whether it's not just pursuing growth based on market demand or a new trend or market opportunity, but also looking at how the business can strengthen their impact. So sometimes we actually shift the priority and look at it more from the impact model rather than just the financial or the commercial acumen of the organization.
Wonderful. Thank you so much for answering that one. You're a brave man. Many would have left that. But well done. Well done. Thank you to Manfred and Tanya. We will be circulating their presentation and this presentation and their slides to the people who are participating, and also to our membership more broadly. I just want to share this one little thing. No. Okay. So thank you once again to Sefa and for coming along. I'm sure that some of the people on the call today are mostly members, so I can skip over that, but I just want to highlight We also have some really great offers for business insurance and also HR support. If you're a member, please get in touch and we can push you in the right direction for that kind of support. And we also have another webinar coming right up on Wednesday, the 9th of August, and that will be a Meet the Board. So Yaz and Adele, our president, our vice president, will be having a chat with our members. So don't miss that one. Pop it in your diary right now. And we're looking forward to seeing that. But thank you everyone for joining today. And from wherever you're watching, I hope you stay well and happy. And we will see you. Survey. There is a survey in the chat. So if you could take some time to jump on the survey, the SurveyMonkey survey, to give us some evaluation around this as well. So thank you all very much and look forward to seeing you at the next webinar. Thanks.
Thank you.
Thank you very much, Elise.
Thank you, everyone.
Bye-bye.